As a young man, I really didn't know what I wanted to do with my life. On my friend Mike's recommendation, I moved to Chicago and began as a runner on the trading floor. I eventually moved up and made bank trading size for one of the most respected firms in the world. In the dot-com bubble, things went south for me. The trader lifestyle caught up and I lost everything. Years later, I fought my way back, and I'm now here to help others on Trader Talk. All right, folks. As a young man, I really didn't know what I wanted to do with my life. On my friend Mike's recommendation, I moved to Chicago and began as a runner on the trading floor. I eventually moved up and made bank trading size for... All right, folks. I just wanted to come on and talk about a spread in RH. RH is a company that makes housewares. It makes like couches and things like that. Let's take a look at the website real quick for RH. It really doesn't matter what it makes because it's a stock which is having earnings coming out soon, and it has an interesting setup. Now, if we look at RH from the last earnings, it gapped up like from 100 to 150 on earnings. So it's made some big moves. You can see the last earnings, it went from, it looks like 120 up to 164 gaps up on earnings. Pretty thinly traded stock. Now, when we look at the option prices for this one, you can see that they're vastly different depending on if you're looking at options before or after earnings. So here we have, okay, options for this week, which is before earnings, clearly 40 vol, looking 48, 50 vol around. But then you look at options for, earnings is supposed to be September 5th. So you look at options after September 5th, on September 7th, for example, you've got 105 volatility. And then if you look the next week out, you've got 91 volatility, 90 vol. Okay. Then if you go to farther out options, like 52 days out, a little bit farther out past earnings, you see vol down to 60. So my idea here is to buy the 60 vol option and sell the 90 vol option against them. So that's what I did. I went ahead and I bought the October 55 calls. So if we go on our little TD Thinkorswim TD Ameritrade application here, if we click on the offer for the October 155 call, that'll bring up buying them on the screen. Then we can go to the September 14th expiration for the same call, the 155 call, and we can hold control and click on the bid. That's going to bring up our spread here. So you're paying $245 for a spread. Now, the good thing about buying a spread is we know how much we can lose on this. We can lose $245 each time we do this spread. So that's the max we can lose, which is a good thing to know. Okay, so and when we look at these option prices, if we break it down a little bit more, okay, so we're buying an option for about $16, and we're selling a SEP option for around $14. So what we're looking for here is, as this comes towards expiration, these SEP options are going to be decaying down. You know, stock right now 157. So this has $2 of intrinsic value in it. So this option has, in the next 17 days, it's got about $11 of decay in it. So what we're looking for is this option to decay very rapidly as it gets close to expiration, whereas the OC one is going to be decaying but much less rapidly, since there's a couple more weeks till October expiration. And indeed, when we analyze this trade, I've got it on 11. I've got that spread on 11 times plus some other surrounding spreads small. We're showing collecting $2.99 a day in Theta, and I've invested about $3,000 in this trade. So I know I can lose up to $3,000, sheets show me collecting $2.99 a day in Theta, so I like that. It shows me collecting 10% or collecting 10% a day in Theta on my money. Now, in practice, this spread may not move, and you may have to wait for earnings and see what happens on earnings to make money on this. But in the meantime, I have the spread on. I paid $2.40 for it, and I'm going to hang out. I can make the decision right ahead of earnings if I want to keep the spread on or not. But seems like a great risk reward to me. Bet $3,000, and you've got $300 a day in Theta decay coming your way. Now, as we move towards earnings, what can potentially happen is that these options don't move at all. So if we look at September, for example, and we check out the prices for options, so the SEP 155 calls right now, 1330. Now, if these are still 1330 bid in another 2 days, that will represent a higher volatility. That will represent like 100 vol. And what they could do is they could just keep cranking this vol up as days go past until the earnings. And this may not come in at all until right at earnings. And then all the money might just flow in right after earnings. So there is some risk involved in this trade. But like I said, I like collecting $300 a day when you're betting just $3,000. So 10% a day coming in on a $3,000 bet. So we'll see what happens. If I do run my theoreticals and start moving the days forward, here, for example, let me get out of the way here for a second. So if I do start running the days forward, it's going to show me collecting money. So if we look at P&L per day, as I run this forward, it shows P&L stacking up. Now all of that is edge stacking up as we get towards earnings. So it's kind of like you have all this money in the bank to play with on the move and earnings, and you just want a move that's not too huge, and you're going to collect all that money. So a little bit of a risky trade here, but an interesting setup which I wanted to share with you. Thanks for watching, and we will see you certainly next time on Trader Talk.